The spot price of silver just crossed $63 an ounce. And if you're watching this right now, you need to understand something critical. The window is closing faster than most people realize. Let me show you what's happening behind the scenes that nobody's talking about. Right now, as I'm recording this in mid-December 2025, silver is trading at levels we haven't seen in over a decade. But here's what's fascinating. This isn't just another price spike. This is the beginning of something much bigger, and the smart money has been positioning for this exact moment for months. I want to take you inside the mechanics of what's actually driving this move, because when you understand the forces at play, you'll see why the countdown clock is ticking so loudly right now. Let's start with what happened in the last 72 hours. Silver jumped from around $58 to over $63. That's an 8% move in 3 days. Now, for those of you who've been in this market for a while, you know that silver doesn't move like this without serious underlying pressure building up. But here's where it gets interesting. This move isn't happening in isolation. Look at what's happening in the physical market versus the paper market, and you'll see a divergence that's absolutely stunning. The COMEX warehouses are showing something remarkable. Registered silver, that's the silver actually available for delivery, has been declining steadily over the past 6 months. We're talking about a 40% reduction in available physical silver for delivery. Meanwhile, open interest in silver futures has been climbing. You see the problem here? More claims on silver, less actual silver available to deliver. This is the classic setup for a squeeze, and it's not theoretical anymore. It's happening right now. Let me tell you about what happened in 1980, because there are eerie parallels to what we're seeing today. Back then, the Hunt brothers tried to corner the silver market. They accumulated massive physical positions, and as delivery demands increased, the price went parabolic. Silver went from $6 to $50 in just a few months. Now, I'm not saying we're going to see that exact scenario play out again, but the underlying dynamics, the tension between paper claims and physical availability, that's remarkably similar. Here's what most people don't understand about silver. Unlike gold, which is primarily a monetary metal, silver is an industrial metal with monetary characteristics, and that dual nature is creating a perfect storm right now. On the industrial side, silver demand is exploding. Solar panels alone are consuming over 200 million ounces of silver annually, and that number is projected to double by 2030. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments worldwide are pushing, it's massively silver intensive. But here's the kicker. Silver mine production has been essentially flat for years. We're not discovering major new silver deposits. The easy silver has already been mined. What's left is more expensive to extract, and many silver mines are actually byproducts of other mining operations. When copper or gold prices drop, silver production drops as a side effect. So you've got surging industrial demand meeting constrained supply. That's economics 101, right? Except there's another layer to this story that makes it even more compelling. Central banks have been accumulating gold at record pace. We all know that. But what's flying under the radar is what's happening with silver at the institutional level. Large investment funds have been quietly building positions in physical silver. The ETF holdings have been climbing. And unlike 2011, when we saw a similar price spike followed by a crash, the hands holding silver today are much stronger. Back in 2011, silver hit $49, and then it collapsed. Why? Because that move was driven primarily by retail speculation. When the price started falling, those weak hands sold, and the selling fed on itself. It was a classic bubble pop. But 2025 is different. The buyers today are institutions with long-term mandates. They're not trading silver. They're accumulating it as a strategic asset. When you have that kind of patient capital entering a market with tight physical supply, the dynamics change completely. Let me paint you a picture of what's happening in the physical market right now. Dealers are reporting premiums on physical silver coins and bars that are significantly above spot price. In some cases, you're paying $5 to $8 over spot just to get your hands on physical metal. That premium tells you something important. There's a disconnect between the paper price and the physical reality. And here's where the countdown clock comes in. As more investors wake up to this dynamic and try to convert their paper positions to physical metal, those premiums are going to widen. The dealers will run low on inventory. The mints will struggle to keep up with demand. And at some point, the paper price will have to adjust to reflect the physical reality. We saw a preview of this in March 2020 during the COVID panic. Silver briefly dropped to $12 on the futures market, but you couldn't buy physical silver anywhere near that price. Dealers were charging $20, $25, even $30 for silver eagles. The paper market said one thing. The physical market said something completely different. Now, imagine that scenario playing out, but instead of a temporary panic, it's a sustained structural shortage. That's what we're potentially looking at here. Let me talk about something that doesn't get enough attention: the silver-to-gold ratio. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, we're sitting around 40 to 1. Silver has been outperforming gold, and that's significant. When silver starts outperforming gold, it's usually a sign that we're in a risk-on environment for precious metals. Investors aren't just buying for safety, they're buying for upside potential. And silver, with its smaller market size and industrial demand component, offers much more explosive upside than gold. But here's what keeps me up at night, and what should have every silver stacker paying attention: the geopolitical dimension of this story. We're watching a fundamental restructuring of the global monetary system. The BRICS nations are actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies. They're accumulating gold. And increasingly, they're looking at silver as a strategic resource. China, in particular, has been fascinating to watch. They're the world's largest silver producer, but they're also a massive consumer. And over the past few years, China has gone from being a net exporter of silver to a net importer. They're keeping their silver at home. Think about what that means. The world's factory is consuming more silver than it produces, and it's not exporting the surplus anymore. That silver is staying in China, going into solar panels, into electronics, into their strategic reserves. India is another interesting case. Indian silver imports have been surging. The Indian population has a cultural affinity for precious metals, and as their middle class grows, that demand is only going to increase. So you've got the two most populous nations on Earth both increasing their silver consumption, while global mine supply remains flat. How does that math work long term? It doesn't unless the price goes significantly higher to ration demand. Now, let me address something important here, because I know some of you are sitting on retirement accounts, watching this unfold, and wondering how you can participate in this without taking on excessive risk. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties, and it explains the mechanics of how these accounts actually work. Worth checking out if that's relevant to your situation, because there are ways to position yourself for this move while keeping your retirement funds protected. Anyway, back to the countdown clock and why timing matters so much right now. Here's what I'm watching closely: the behavior of the commercial traders on the COMEX. These are the big banks and institutions that typically short silver to hedge their physical positions. For months, they've been reducing their short positions. That's unusual. Normally, when silver prices rise, the commercials increase their shorts to cap the rally. But not this time. This time, they're backing away. And when the smart money that usually suppresses price is stepping aside, that tells you something important about where they think this is headed. There's also the technical picture to consider. Silver just broke through major resistance levels that have held for years. The $60 level was significant resistance, and we blew through it. The next major resistance is up around $75, and after that, we're in uncharted territory for this cycle. Technical analysis isn't everything, but when you combine strong technicals with powerful fundamentals and shifting institutional behavior, you've got a setup that's hard to ignore. Let me tell you about a conversation I had with a dealer last week. He's been in this business for 30 years, and he told me something that stuck with me. He said, "In all my years doing this, I've never seen demand like this combined with supply constraints like this. Something's got to give." And he's right. The market is sending clear signals that we're approaching an inflection point. Think about the investment demand side for a moment. Silver is still dramatically underowned by institutional investors compared to gold. The total value of all the silver ever mined is a fraction of the gold market. It's a tiny market by institutional standards. What happens when even a small percentage of institutional capital decides to allocate to silver? The market simply can't absorb that kind of buying without significant price appreciation. We're talking about a market that's measured in the tens of billions trying to absorb potential demand measured in the hundreds of billions or even trillions. The leverage in that equation is enormous. Now, I want to talk about the supply side in more detail because this is where the countdown clock really becomes relevant. Silver mining is a complex business. Most silver comes as a byproduct of other mining operations: copper, lead, zinc, gold. Only about 30% of silver comes from primary silver mines. That means silver supply is largely dependent on the economics of other metals. If copper prices drop, copper mines slow production, and silver supply drops as a side effect. The silver market doesn't have direct control over its own supply in the way that gold does. And here's the thing. We're not seeing a wave of new silver mine development. The permitting process takes years. The capital requirements are enormous. The easy deposits have been found. What's left is deeper, lower grade, more expensive to extract. Even if silver prices double from here, it would take years for new supply to come online. In the meantime, industrial demand keeps growing. Investment demand is increasing, and the existing supply is getting tighter. This is why the countdown matters. Once the physical shortage becomes obvious to the broader market, once the premiums on physical metal start spiking, once the delivery delays become widespread, at that point, you're not getting in at these prices anymore. Let me give you a historical parallel that's instructive. In 2008, during the financial crisis, silver dropped to around $9. But if you tried to buy physical silver at that price, good luck. Dealers were out of stock. Mints couldn't keep up with demand. The paper price said $9, but the physical market was trading at $15, $18, $20. That disconnect lasted for months, and by the time supply normalized, silver was already back above $15 on the paper market, heading toward its eventual peak of $49 in 2011. The lesson there is that when physical shortages develop, the paper price becomes almost irrelevant. What matters is what you can actually buy metal for, and that's determined by physical supply and demand, not by futures contracts. We're seeing early signs of that dynamic developing again. The premiums are widening. The delivery times are extending. The dealers are reporting strong demand and tightening supply. And here's what makes this time potentially more significant than 2008 or 2011. The structural drivers are stronger. The industrial demand is more robust. The monetary system concerns are more acute. The institutional interest is more serious. This isn't just a fear trade or a speculation bubble. This is a fundamental repricing of a strategic industrial and monetary metal that's been undervalued for years. Let me talk about the monetary aspect for a moment, because this is crucial to understanding the full picture. Silver has been money for thousands of years. It's mentioned in the Bible as a form of payment. It was the primary currency for most of human history. The US dollar itself was originally defined as a specific weight of silver. But in 1965, the U.S. stopped making silver coins. In 1971, Nixon closed the gold window, ending the last link between the dollar and precious metals. For the past 50-plus years, we've been in a pure fiat currency system. And how's that working out? We've got inflation running hot. We've got government debt at levels that would have been unthinkable a generation ago. We've got central banks printing money at unprecedented rates. We've got negative real interest rates in many countries. People are starting to question the long-term viability of fiat currencies. And when they do, they look for alternatives. Gold is the obvious choice, but silver offers something gold doesn't: affordability and industrial utility. You can buy silver in small denominations. You can accumulate a meaningful position without needing tens of thousands of dollars. And unlike gold, which is primarily a store of value, silver has industrial applications that provide a fundamental demand floor. That combination makes silver uniquely positioned for this moment in history. Now let's talk about what could derail this thesis, because it's important to consider the counter-arguments. If we see a major deflationary collapse where economic activity grinds to a halt, industrial demand for silver could drop significantly. That would put downward pressure on prices, at least temporarily. If the dollar strengthens dramatically, that typically puts pressure on commodity prices, including silver. If we see a major technological breakthrough that reduces silver usage in industrial applications, that could impact long-term demand. These are real risks, and anyone investing in silver needs to be aware of them. But here's my assessment of those risks. The deflationary scenario seems unlikely given the amount of money printing and fiscal stimulus we're seeing globally. Central banks have made it clear they'll do whatever it takes to avoid deflation. The dollar strength scenario is possible, but even if the dollar strengthens against other fiat currencies, that doesn't necessarily mean it's strengthening in real terms. If inflation is running at 5% and the dollar index goes up 3%, you're still losing purchasing power. And on the technology front, while it's true that innovation could reduce silver usage in some applications, we're also seeing new applications emerge. The green energy transition is massively silver intensive, and that's not changing anytime soon. So, while risks exist, the base case scenario still points to higher silver prices over the medium to long term. Let me bring this back to the countdown clock and why action matters now. Markets don't move in straight lines. Silver is volatile. We could see pullbacks. We could see consolidation. But the underlying trend is clear, and the structural drivers are in place. The question isn't whether silver is going higher. I think the evidence strongly suggests it is. The question is whether you're positioned before the next leg up, or whether you're chasing it after it's already moved. Right now, at $63, silver is still below its inflation-adjusted all-time high from 1980. If you adjust that $50 peak for inflation, we're talking about $180 in today's dollars. Now, I'm not predicting we're going to $180, but it gives you a sense of how much room there potentially is to the upside. Even a move to $100 would be less than a double from here. That's not crazy when you consider the fundamentals we've discussed. And here's the thing about silver. When it moves fast. In 2011, silver went from $25 to $49 in just a few months. In 1979, 1980, it went from $6 to $50 in less than a year. Silver is a small market with big leverage. When the momentum shifts, it can be explosive. So, the countdown clock is ticking, because we're in that phase where the smart money is accumulating, the fundamentals are aligning, and the technical picture is breaking out. This is the phase where positions get built, before the broader market catches on. Once silver is on the front page of the Wall Street Journal, once it's the topic of conversation at dinner parties, once your neighbor is asking you about it, at that point, you're late to the party. The time to position is when the story is still developing, when the pieces are falling into place, but the crowd hasn't arrived yet. And that's where we are right now. I want to leave you with this thought. Silver is one of the few assets that offers both defensive and offensive characteristics. It's a hedge against monetary instability and inflation, but it's also a play on industrial growth and the green energy transition. That dual nature makes it uniquely valuable in the current environment, where we're seeing both monetary concerns and industrial transformation happening simultaneously. The countdown is on because these forces are converging right now. The physical market is tightening. The institutional interest is growing. The industrial demand is accelerating. The monetary concerns are intensifying. All of these factors are pointing in the same direction, and that direction is higher prices. The question for you is simple. Are you positioned for what's coming, or are you going to watch it happen from the sidelines? The clock is ticking. The window is open. But it won't stay open forever. Silver at $63 might look expensive compared to where it was a year ago. But if the thesis I've laid out plays out, $63 is going to look like a bargain a year from now. This is the moment where decisions get made, where positions get built, where the foundation for future gains gets established. The countdown is on. The question is, what are you going to do about it?